Welcome to Chronos Talks, a place for some candid thoughts on the worlds of sustainable finance and corporate sustainability. On today's pod, we're talking investor stewardship, and Chronos CEO Rory Sullivan is joined by Dan Mikulskis, Chief Investment Officer of People's Partnership, one of the largest asset owners in the UK with more than 7 million members. Dan was previously at Reddington, Mercer, and was a partner at LCP, and we're delighted he can join us. Let's hand over to Rory for the discussion.
Thank you, Elliot. And Dan, welcome to Chronos Talks. Dan, this is a bit unusual because they say you should never meet your heroes. Today is the first time we've met, but I think you've moved into my pantheon of heroes with the People's Partnership's decision to change its fund manager on the grounds of stewardship. So I'm hoping that I'm not going to be disappointed by the conversation we have over the next 15 or 20 minutes or so. But if I may, before sort of moving to talk about the process you went through and the factors that influenced your decision, I wonder if we could start at the very beginning, because having sort of stalked you on LinkedIn, there's nothing in your background to suggest that you'd become a hero of the sustainability movement. I mean, you did a master's in maths, what looks like a decade doing quant trading, and then obviously you moved into consulting with Reddington, LCP, etc., before joining People's Partnership. So I guess the first question I have, if you don't mind, is can you maybe describe where did sustainability or sustainable investing first appear in your thinking as a matter of importance? Like, when did it become important?
Oh, yeah, lovely question. Thanks, Rory. Thanks for the kind words at the start. Great to be here. Great to be speaking with you. And yes, hopefully I can live up to that rather large billing.
No pressure.
No pressure. Let's see. I was trying to ask myself this question and trying to sort of think back. And yeah, I suppose that thinking kind of developed during my career, really. My sort of career, very briefly, I consider myself a reformed quant in that I was very much a mathematician, sort of growing up, if you like, for my sins. I grew up in effectively a household of mathematicians, studied maths at uni, did actuarial studies. I loved the quant models, loved the fact that you could sort of build these models of the world, and they broadly seemed to explain what went on and the power of sort of building those models and over time sort of mastering them. And I felt that got me really far, which was great. And quant modeling in general does get you pretty far in terms of understanding the world. But there was a little bit of a moment of realization, maybe sort of, I don't know, like 15 years into my career sort of thing, where I was like, okay, actually, it gets you so far, but it does miss some things out. And actually, when you start thinking about it, the stuff it misses out is actually pretty important and does undermine a little bit the sort of the hegemony, if you like, of the quant model. So it was sort of that the realization that came about. And I'm not trying to claim for a minute that I was like at the forefront of this of that sort of movement. I was very much sort of riding the wave. I'm talking that period of time post Paris Agreement, probably just pre COP26, that period of time when ESG experienced the real upsurge in the sort of focus and interest on it, which went down good and bad directions. We can maybe talk about that. So I'm not for a moment claiming I was one of the sort of leaders of that thing, but nevertheless, that was my journey and my experience, and the quant models were great. Then there's a realization that they leave some things out. And I suppose if I was to pinpoint a couple of things that I read, it was even through the framework of quant models that I understood that. It was in terms of almost thinking about externalities. And when I started realizing that actually, yes, I mean, it's a modeling point, I suppose, in itself, but there are externalities there that if you brought them back into the way you're looking at companies could cause you to look at things completely differently. If you, for example, if you were properly pricing in the externalities and the cost that some companies heap on the world, you would wipe out their profits and wipe out the market cap. You wouldn't view them as successful companies anymore. You probably wouldn't invest in them. And that was sort of the start of the realization of, there's some stuff that gets missed out there.
And then at what point did you start going from the realization that these issues are important to actually having the confidence to, I guess, first talk about them and then act about them? And I guess the reason for that question is it came up, as you know, we've just done a guide to careers and sustainability, and that question of career risk. So at what point does something become concrete enough or certain enough that you can talk about it with confidence? Because you become a very public commentator on sustainability issues, but I say it's quite unusual for someone in your position. So I'm just very intrigued as to when you felt confident enough and how you managed that, I guess, raised eyebrows in the room that probably accompanied that conversion.
I've always sort of seen myself as a generalist who has a good understanding of that area. And I sort of say that quite deliberately. I never wanted to hold myself out as an expert in sustainability because I'm not, right? I don't have like a master's degree in sustainability like a lot of people have. I've not been doing ESG since 2006 like a lot of people have, right? So I was at LCP prior to being at People's Partnership as a consultant. And I could see there was a value in generalists developing more of an understanding in that area and reaching across, because the issue that I felt I could see was that it was quite siloed. And so you had these great responsible investment teams, these great sustainability teams operating within firms like LCP and others. LCP had a great team, but they were siloed and they were a little bit sort of restricted and suppressed in terms of what they could actually do because of that. So I felt there was a need for like generalists to sort of basically reach across, upskill themselves enough to be able to sort of broach the conversation, bring other people in, set it within the context of the wider thing. So you could just sort of set it in the right place, if you see what I mean. So I guess that is probably what I would see my role as, and I pretty much continued that trajectory, I guess, at People's Partnership, right? I'm the CIO, so I cover all aspects of investing. We have a very, very good, strong, responsible investment team, but as the CIO, you really have a choice about how you embed that across the investment portfolio and across the investment program. You have a choice about whether you treat it as a silo, you keep it just off to the side and sort of ask their opinion every so often, or whether you genuinely do integrate it across everything. So that's kind of how I see that.
So Dan, just for the listeners who may not be familiar with you, can you just describe what is People's Partnership? What's your purpose and mission as an organisation?
Yeah, so People's Partnership is the provider of people's pension, which is a wonderful tongue twister that we've managed to create there with all the P's. People's Partnership in itself is a super interesting organisation. So I'll give a quick back history of that, but then I'll get to the People's Pension, because that's basically the interesting bit these days. People's Partnership is a profit for member organisation that arose out of the construction industry in the 1940s. The roots are in the sort of trade union, federated employer kind of movement, construction industry employers coming together to deliver financial products to underserved communities on a profit for member basis, essentially. So our first ever product was holiday pay stamps for construction workers back in the 1940s when holiday pay wasn't really a thing. And then it went to, I think, individual insurance, and then a stakeholder pension scheme emerged. And obviously in 2012, the world massively changed because of auto-enrollment in the UK defined contribution space. And the then management of the company decided to launch it as a auto-enrollment master trust, which became the People's Pension. And obviously that's been pretty successful, to put it mildly, in terms of the growth. Because of the profit for member sort of status, we were able to serve companies right down to the smallest end of the spectrum, whereas the difficulty at auto-enrollment was that the main providers basically wanted the bigger employers because they were just more profitable. We were able to serve smaller employers right down to sort of 2-3 person businesses, 10-person businesses all over the country. So built up a really broad spectrum of employers that use us. We have about 100,000 businesses that basically use us to provide a pension to their employees. And that over time has compounded into quite a large inflow of assets and quite a large portfolio. And then the growth has been staggering, really. I mean, we were sort of something like £6 billion just before COVID, I think like 2018, 2019, and we're now almost £40 billion. We take in over £4 billion of contributions every year. So the growth has been quite staggering, and it's an absolutely wonderful privilege to be a part of that journey, honestly. I spent a lot of my career working with pension funds and with CIOs, and over the time you sort of daydream about what you might do, if you got the chance, and it's been really, really great to be able to do that.
So Dan, before I ask you about your role, I'm going to ask you an embarrassing question, which is, why did they choose you? So what were they looking for you to do when they brought you in?
Well, I've asked myself that question quite a lot as well, Rory. So, I'm not sure. Yeah, totally get that. I mean, I don't know that I was an obvious choice as a CIO. I guess purely because I hadn't been a CIO before. So I guess if you're looking for a CIO, you tend to look for people with that on their CV. I guess what I did have was, let's just say, a little bit of experience of working with a range of CIOs. So there was a bit of a sense of, there's bits from here and there that I thought were good that could sort of bring together a little bit. And I guess in particular, if there was maybe one thing that I suppose I majored on, it was just this idea that we ought to really become an asset owner at the scale we were at. So we were at £20 billion when I joined the business. And that is of sufficient scale, in my view, to become an asset owner in the broad definition of what I consider an asset owner to be. And that isn't how UK DC funds had approached the world really up until that point. Mainly because when you're small, you're trying to get going, you focus on serving your members as well as you can, marketing your product, and then you sort of outsource the investment to a cheap, efficient, passive option, which worked really well because those funds have generally performed well and they offered good value for money for the providers. That's how UK DC funds started off. But I think at a certain size, you need to grow that up. A certain size brings greater responsibilities, and at a certain point you've sort of got to take that on and turn yourself more into an asset owner than simply a provider of a pension where you kind of outsource the investment to someone else. That was really the philosophy, I suppose, that I was trying to bring, and I've spent the last 2 years trying to put that into practice, really.
So do you want to then start talking to, if you don't mind, what you've done? I guess I'm now moving towards the review of your managers and the decisions you made, but I mean, if you maybe want to talk about it as a process and then turning to the decisions you made on changing.
A lot of it comes back to that idea of we needed to upgrade the asset ownership model that we had. So all of the things we did, in my view, feed into that as a wider kind of journey. And the ownership model we had at the start was pooled funds, one provider, all passive, very common starting point. But we were big enough to grow that up. And so we wanted to have a situation where we had multiple managers working for us. We didn't want to have loads. I think some asset owners end up with too many. We wanted a small number. We wanted to have direct ownership of the assets. So we wanted segregated mandates that really put us in control. And we wanted to be working with partners that we felt were really aligned to be able to deliver our strategy. So those were some of the principles that we were sort of working to at the very basic level as we built out the ownership model. And so a couple of points there, as we sort of hone into your question, I guess a couple of the points there are really key. The seg mandates is really, really important for this whole area, I believe. That was a massive unlock for us. But also, I guess, this concept of alignment is probably worth thinking about a little bit, because even we're a sort of moderate-sized asset owner in the global context today. We might get to a point where we're a large asset owner in a global context. But if you're investing globally, even the biggest asset owners are still not that big compared with the size of global markets. Even let's say you're a $300 billion Californian pension fund, that is still not that big in the global market sense. So the point is, you still rely on managers really to deliver your strategy, to interact with the market for you, to interface against the companies that you're investing in. And so you better be aligned with the managers that are doing that on your behalf, basically, in the way you want to do it. And that, I think, was at the heart of that journey we went on, and was saying, look, we're building this asset ownership model from the ground up. We need to build it with the partners who are as most aligned with us as they can be. You maybe can't get perfect alignment, but let's at least do a really honest assessment of, is there alignment with us? And the issue that I think a lot of people have found is that there's been a huge trend to passive over the last decade, which has generally been pretty good for investors because the returns have been great. That trend has pushed assets to a relatively small number of very large passive managers. And to give them their credit, what those managers have done really well is shown the benefit of scale in investing, and they've shared the benefit of scale with the members. In other words, the fees are really cheap, which is great because, you invest passively, 99.97% of the value added stays in the hands of the end investor. And that is a brilliant deal for the end investor, I think. This was great. So let's give the big passive managers their dues in saying what they've done there is great. But they were very successful in that, which is good for them. But the issue in that success is they then had a very broad spectrum of clients. And then this question of alignment just got a bit thornier because they then clearly can't align with all their clients. That's just not possible. So when you're as one client looking to say, well, am I aligned with that manager? It was increasingly clear over the last probably 3-4 years that it was a bit harder to get that alignment, particularly with some of the US managers, basically.
And even in a segregated context. So even though you could have direct control over your assets.
Great point. But again, just to dig into the alignment concept, we distinguish between firm-wide level alignment and product level alignment. They're different, basically, I think. And it's horses for courses. In some asset classes, we're happy with product level alignment. And product level alignment basically means the team that are managing my assets are completely aligned with me. Their firm might not be, but the team totally is. And that you can definitely deliver through seg mandates, you're right. And in some asset classes, like for us in fixed income, for example, we think that's fine. That's perfectly good. There are some asset classes where we do think you need firm-wide alignment, though, because of the voting. So in equities, because the voting is often a house policy, even if the team is totally aligned with me, if they're working on the basis of a house policy that's being determined by a head office somewhere else, that's where the issue crops up. So when we really drilled down on it, we felt that equities, we needed the firm-wide level alignment. There was just a limit to what you could put in the SMA. I mean, yes, we could, obviously, the voting, for example, we could take it on ourselves, but then you've got the rest of the engagement and stewardship process. So it's still not exactly solving it. So we kind of felt that on the equities side, the gold standard was a manager that was as aligned as they could be with the way we would see the world, and also seg mandates to sort of deliver that as well, kind of belt and braces type approach.
So you've made the decision to appoint a Monday. One question I've got is that enough? So you've chosen a manager who's segregated assets, aligned values. Is that it? Or what are you going to do to raise their game or to steer them in your direction a bit more? Or is that allocation decision alone enough?
Well, no, it's obviously going to be an ongoing conversation, an ongoing question of their level of alignment with us. We're trying to develop ways of assessing their voting activity, for example, against our, and I only bring up voting because obviously it's the most measurable of the parts of their activity, right? Yeah. I'm not trying to say that that's the only bit. In fact, it's not even the most important, but it's one thing you can measure in terms of alignment. We've done a little bit already looking at the last proxy season, trying to assess their voting compared with where we would be on it. We actually released our implementation statement not long ago for the prior year, not generally a publication that gets loads of interest, but in that actually for the first time we published some alignment assessments of the managers we had back then, which was still State Street for equities, and a framework that we developed with working with Minerva on that. That's in the public domain. And we'll be refreshing that each year, so that will get applied to Amundi and Invesco and the newer managers as we go forward as a sort of ongoing assessment of how closely aligned are they. And obviously we have a constant dialogue with their teams in terms of what's going on. But the early signs are that the activity in the 2025 proxy season was very, very close to where we would have wanted the votes to go. And it's things like, voting against directors, for example, is something that we wanted a manager to do, whereas some managers take the view that that's just not what they do, which is a sort of almost a philosophical position, isn't it, as to whether you should, as a passive manager, vote against directors. And if you're going to do that, you need a clear guidelines as to how and when you do it, because those votes are just generic votes, aren't they? So that I think is one area where you can really look at and try and test that alignment, but it's promising so far.
Obviously it's still early days, but do you have any lessons learned or reflections either on the process or what's happened so far that sort of you would share with the listeners?
There was a few key things that we did that I think were quite important. Some maybe, as always with these things, more by luck than judgment sometimes, but they turned out to be important. I think the first thing was writing down and publishing our responsible investment policy. Then it was in black and white, exactly what our standards were and what we wanted. And also thinking really hard about that policy to try and really get it right, have it really clear-cut, defensible. I think the logic in them can sometimes be a little bit fuzzy and messy, if you like. So trying to really drill down on that policy and be like, no, it has to be totally robust. It has to make sense, has to be internally consistent. It has to face into trade-offs, acknowledge them, not try and fudge them, sort of thing. So we got some really good help from some kind of academics, including Alex Edmonds, for example, who's very good at really honing in and being like, no, that's not logically consistent with that. That doesn't totally make sense, which is really, really helpful to get that kind of exposure on it. I'm not trying to say our policy's perfect, but I think we did manage to get it in a pretty good, robust place. And then everything sort of built off that, because our whole assessment of alignment is then versus that policy. As we started the process of looking at managers, you could give that to the managers because it was public then, and say, right, go away, have a look at this, come back to us and present exactly how you're aligned to this or not. So the policy was absolutely fundamental because that crystallizes the conversation. And until that point, managers can always tell a good story about the stuff they're doing well. They can always focus on this bit or that bit, and you can never really nail the conversation down. But once you've got the policy, you can nail the conversation down a little bit. So that was one bit. Another key bit actually comes back a little bit to what we were talking about earlier, was not treating it as a responsible investment piece of activity. The review we were doing was a review of the equities manager. And so it was led by the equities team, with sponsorship from me as the CIO, with all facets of the team feeding into that. So we had all sorts of haggles over what the weighting was to the responsible investing alignment, but it had its weighting alongside other things in a balanced scorecard. And overall, it was being driven by the equities team as an equities decision. The responsible investment piece was being advised essentially by the responsible investment team. So I think that was quite important, because I think often those initiatives tend to be driven by an RI team, a sustainability team. And I just don't think that's enough, because you're going to get that tension between the equities team and that team. So I think my role there as the CIO was to say, right, we are doing a review. Here's who's leading it. Here's the parameters for that review. Here's how I want you to go away and assess these different bits. Now, go away, work together, do it, and come back with a recommendation that sort of fits that framework. So that, I think, worked pretty well. And yeah, I suppose the final bit, which maybe a bit more lucky, is that I suppose we were among the first people to maybe do that publicly, but we weren't at the very start of it. So there were slightly more options than you might have initially thought. Obviously, Amundi, a bit more of a newcomer to the UK in the passive space, but not very new at that point. They'd been in the UK for a good few years. So that was nice. And that is one thing that I would encourage other people to think about, that there probably are more options there than you might think. And you can feel that you're very entrenched with the manager, but there will be other options. And sorry, and just finally, just on the seg mandates as well. The segregated mandates, and not every asset owner has that option, because there's a size constraint on that, obviously, but it makes that far, far easier to do the switch over. When we switched managers, it was almost a zero cost type switch. One manager switching out, one manager switching in. And that makes it so much easier, because this obviously comes back to this question of fiduciary duty, and in what sense are you costing members by making that change. And it was very clear in our case that when you looked at the fees were being paid, you looked at the indices that were being tracked, exactly the same or better. You looked at the cost of the switch over, it was almost nothing. So there was very little case to be made to say that there was a compromise being had to sort of deliver that. I think that was quite important to be really clear about that.
Okay, Dan, we have a couple of minutes left. So should we turn to some bigger, wider questions?
Yeah, of course. Yeah, let's go for it. Yeah.
So Dan, the first question I have is, you've consistently over the last decade or so emphasised the importance of good stewardship and engagement as an integral part of being a good investor. I'm just interested in, does that thesis still hold, given how energy prices have gyrated following Russia's invasion of Ukraine, or as we endure the ESG backlash? I'm just interested in where that commitment to long-term sustainability and to stewardship sits in the world, which is much more, I guess, uncertain and less harmonious than it was a few years ago.
Absolutely. I still believe in that. And yeah, I guess just to dig into that quickly, I think it often gets drawn into a financial debate, doesn't it? It's like everything has to be seen through the lens of, is it managing financial risk and return? And it is true that that's where our responsible investment objective starts from. But I think there's a dimension of good stewardship that is unrelated to returns, i.e. it's probably neutral to returns, but you still have a choice about where your stewardship is in a sense that's neutral to returns. It's almost like being a good landlord, right? There's a concept of, everyone knows, has probably experienced a good landlord and a bad landlord. It's not necessarily that the bad landlord makes any more money than the good landlord, but there's a good and a bad way of going about it, right? And I do think it's quite similar with stewardship. And so we managed to get into our RI objective, the sense that where it's neutral to returns, we believe in stewardship for benefiting the wider world. Now, that is important to philosophically how I see it, in that there's quite a broad spectrum of stuff that's probably neutral to returns. You just don't know, right? You can't measure this stuff in basis points. But there's an argument to be had there that better stewardship is good if it's sort of broadly neutral. Now, that's the sort of starting point. Yes, in general, stewardship has become a lot more challenged. Obviously, we're in a worse environment for that than we were a few years ago. There's no question about that. But I'm just a relentless pragmatist. So I'm kind of like, right, well, that's done. That's the environment. Can't change that. What it does do is make it even more important that you're with someone who's aligned, because that whole environment gives far more cover for people who aren't aligned to continue not being aligned, I think is the key worry there. So yes, the environment is worse. No, we can't control that. All we can control is who we're working with and sort of what we're asking them to do. And so I think, yeah, it's even more important that we're with an aligned partner there. And I have always felt throughout the whole kind of journey that ESG has been on over the last, call it 8 years, I think there is quite a progressive coalition out there that is reasonably progressive on some of these areas. Now, it's not a majority. It's not more than 50% of shareholders in big companies. It was never that much. But it's not nothing. And you don't need more than 50% of shareholders, as you know, because you will absolutely get the attention of boards and chairs. If managers have even got 10% of the vote behind them, they'll get a meeting. And the chair might well start that by saying, okay, what do we need to do? And it was just, in my mind, a sense that there was still a bit of a sorting exercise to go through to really identify that coalition and get it behind certain areas. And unfortunately, if you look at the votes in the last proxy season, the shareholder proposals didn't seem, in most cases, to really hit the mark for that coalition, I guess, because they just weren't getting close to the levels of support that I think is possible. So I think there is a bit of a sense of there needs to be a bit of a rethinking. First, it'd be great to better identify that coalition, know who they are, understand what kind of proposals they want or they could get behind, and then find a way of getting those proposals sort of out there so that you are seeing the kind of, 10, 20, 25% type support levels that I think ought to be feasible given the kind of people that we know are behind that.
I mean, obviously the Stewardship Code has been revised and updated. I mean, does that help or hinder this problem? Does it make it more or less likely you'll be able to establish coalitions and that they'll be able to find a sort of a common ground or a common agenda that they can then take to companies?
The revision of the Stewardship Code was very hotly debated, wasn't it? I mean, people really on both sides of that. Didn't the argument basically boil down to the definition of stewardship was perceived as being slightly diluted, but that may have been helpful because it then can engage a slightly broader base on it. And I probably come down on the side of it probably being a good thing. The Stewardship Code in general is brilliant and is really important. I mean, just the other day I was looking at our IMAs, our investment management agreements with our managers. There's something like 35 direct references to the Stewardship Code in those agreements. So we're very specifically saying in a certain clause of the agreement, pursuant to paragraph 5, part 2.3 of the Stewardship Code, you will do this on our behalf, sort of thing. And the manager signs up to that in a legal sense. And if they don't do it, then it's potentially a breach of contract. So it's really helpful for setting the standards there for the managers. It's a very tricky balance in this area, as I'm sure you know, in that there's the sort of the urge to go the full hog, if you like, towards one's views. But in any kind of market-driven world, the reality is you can't run that far ahead of where the market is, because that's just then not a reasonable position. You then just become isolated and effectively irrelevant. What you can do is kind of push like a little bit ahead of where the broad market is, and that's actually probably more helpful than trying to go all the way out there as much as someone might want to do that. So I again, back to being a relentless pragmatist, I felt that was maybe the positive bit in the change in the Stewardship Code, was maybe recognizing that it couldn't push the whole way out. It was actually more helpful to dial it back a little bit and try and push out a little bit more from the middle, if you like.
Well, Dan, that's a beautiful segue into my last question, because I'm going to call you out on being a relentless pragmatist. And I'm going to ask, what is the one thing that now that may be you as an individual or perhaps you as the People's Partnership can do to advance or encourage more or higher quality stewardship?
Well, yeah, I think it's very important for everyone to ask that question of themselves and to be really honest about where they have people use the term efficacy, don't they? Like where you can actually do stuff, basically. And I think it is true that we have the most leverage with managers and other service providers to some extent. So I think changing managers was the first thing, but just being super vocal in general. You have seen managers make little changes in response to stuff we said. When we went through our process, we were able to extract various kind of deals from managers. So I think being pushy towards the manager community a little bit, trying to tell that story a little bit, is probably one of the main kind of things. And then the second thing you can do is sort of throw your weight behind external kind of independent things and kind of say, yeah, look, we think this is good. We support this. We like that. So, in our recent RI report, we talked about some of the external things we like. Just one example I'll throw out, I think the share action voting rankings has been very good in teasing apart that difference between European and US managers that's been coming for a long time. So I looked at that for years. We looked at it as part of the process we went through. We did use that a little bit to inform our choices of managers. So yeah, I think it's pressure on managers. It's being a little bit more vocal out there. It's putting the stuff out there in the public domain and trying to use the sort of leverage we have on the fund manager community, I think a little bit would be probably the main thing.
Thank you, Dan. I think with that, we're going to wrap up. Can I just say that I think that the role the People's Partnership has played and continues to play is and has been and continues to be really important. I think we're not going to make progress without the grim realists and pragmatists, taking ownership of some of these issues and pushing them forward. It's been a wonderfully informative conversation. So thank you for joining us.
Thanks, Rory, so much. Really enjoyed the conversation. Thanks so much for having me.
Do have a look at chronossustainability.com for more on our work on investor stewardship and responsible investment, and for other episodes of the Chronos Talks podcast. You can also follow us on LinkedIn via the handle @Chronos Sustainability for all our news and updates. Thanks for listening.